Welcome to Iron Financial, where we forge stronger portfolios and cut through market weakness. Today, we're putting Wix.com under a serious stress test. Now look, the stock has been on an absolute tear, up nearly 50% in just the last 6 months. And management, well, they're out there talking about a defining new chapter, all powered by AI. And that brings us to the core question we have to answer. Is all this excitement, all this growth, built on a solid, steel-reinforced foundation? Or are we looking at a structure that's really just built on pure hype, a house of cards ready to tumble at the first sign of trouble? It's time to find out. Let's get to the drill down. Okay, here's how we're going to attack this. We're going to break it down methodically, piece by piece. First, we're going to dissect their big AI gambit. Is this a true game changer, or is it just the latest marketing buzzword? Then, we'll forge the top line, putting their revenue growth under the microscope to see if it's actually made of strong stuff. From there, we'll fire up the cash flow furnace. Is it a raging inferno of profit or just a pile of dying embers? Then, and this is crucial, we'll go searching for any cracks in the armor, the hidden weaknesses. And finally, after all that, we'll deliver the iron verdict.
Right, let's start with the story. You know, every company, especially in this market, has a narrative they want you to buy into. It's the elevator pitch. So, what's the official story Wix is selling to Wall Street right now?
And there it is, straight from the top. This is the absolute core of the bull case for Wix. The CEO, Avishai Abrahami, is basically telling the entire market, forget the Wix you thought you knew. He's signaling that this is a totally new AI-powered machine. And he's not just being vague about it. He's pointing to two very specific pillars that he says will hold this new structure up. Wix Harmony, which is their AI website builder, and Base44, their new no-code application platform. He's not just talking about a new feature here. He's betting the company's entire multi-billion-dollar future on this pivot.
Right, the AI narrative. Of course. It's the story of the year, isn't it? I swear, it feels like every CEO is contractually obligated to say AI at least 5 times on every single earnings call. But look, our job here is to look right past the buzzwords. Is this a genuine, structural shift for the company? Are they fundamentally changing their business model for the better? Or are they just slapping a shiny new AI sticker on the same old engine to get the stock price up? You know, words are cheap. Talk is cheap. So let's move on and see what the hard numbers have to say.
All right, let's fire up the forge and really see what this top line is made of. We need to know if we're dealing with high-grade steel here or just cheap, brittle iron. You know, a company's real strength, it always starts at the top line. We need to see if this revenue engine actually has the horsepower that they claim it does.
Okay, on the surface, the Q4 numbers look pretty solid. Total revenue hit $524.3 million, and that's up a respectable 14% year over year. That's a number with some serious tensile strength, and it landed right in line with what Wall Street was expecting. But here, right here in this table, is where the story gets really interesting. You have to look at the components. Creative subscriptions, that's their core business, the classic website building tools, it's growing at a solid 12%. But look over at business solutions. This is the new stuff, payments, e-commerce tools, all that. It is absolutely in the fast lane, accelerating at a powerful 18%.
And this chart really drives that point home. Creative subscriptions, no doubt, is still the heavy lifter. It's making up 71% of the total revenue. You can think of this as their bedrock, the massive foundation that the entire structure is built on. But the real growth engine, the part of the business that is clearly powering the future, is business solutions. This segment is becoming a much more significant piece of the puzzle, and that is exactly what you want to see in a company that claims it's evolving for the future.
This is the trend. This is the chart that every single serious investor needs to be watching. That 18% growth in business solutions, it proves they are successfully expanding beyond just being a simple website builder. They're building a more complex, a more integrated ecosystem, where their customers are coming in for one thing and then spending more money on more services. That right there is a sign of true structural integrity. It shows they can upsell, they can cross-sell, and that creates a sticky platform that customers don't want to leave.
Whoa, hold on a second. A single quarter of growth? That's just a snapshot in time. Let's pull the camera back and look at the actual blueprints for this thing. This analysis from Stock Stories shows that the 5-year compounded annual growth rate is a healthy 15.1%. But look at the more recent 2-year rate. It's slowed down to 13%. That has a name. It's called deceleration. The engine is literally losing RPMs. Now, for a company that's supposed to be on the verge of some new AI-fueled growth explosion, shouldn't that number be going up, not down? So where's this AI-powered turbocharger we keep hearing so much about? I'm not seeing it here.
That's a completely valid point, and we never ignore deceleration. But you have to look at their own guidance for 2026. They're telling the market to expect mid-teens % growth. Now, what that suggests is that they have a plan to re-accelerate from that 13% two-year average. They're telling us they're about to put their foot back on the gas. And the raw material for that growth, the fuel, it comes from bookings. Bookings were up a very strong 15% in Q4, hitting $535 million. And for those who don't know, you can think of bookings as signed contracts for future work. It's revenue that's already been secured, it just hasn't been officially recognized on the income statement yet. Okay, but guidance is a promise, not a payment. And bookings are just that, bookings. They're not cash in the bank. It's a leading indicator for sure, I'll give you that, but it is not the same as cold, hard cash. So let's stop talking about promises and let's see if the profitability, the actual cash, can support that promise. Let's move on to the cash flow and see how this all really melts down.
Absolutely. Now we get to the most important metric of all. You've heard the saying, revenue is vanity, profit is sanity. But cash is reality. A business is effectively worthless without a strong, reliable foundation of cash flow. This is the furnace that powers the entire operation.
And this right here is where the bull case for Wix gets its real strength. The company generated an incredible $573 million in free cash flow for the full year 2025. Let that number sink in. That is the lifeblood of the company. That is the real, spendable cash that's left over after all the bills are paid. It's the cash that funds the R&D for their new AI tools, it's what pays down debt, and it's what they use to buy back their own shares. This isn't just a furnace that's burning hot. This thing is practically a blast furnace, just churning out cash at an incredible rate.
Now, to put that number into perspective, if you strip out some one-time acquisition costs they had, their free cash flow margin was a stunning 30%. Think about that. For every single dollar in revenue that came in the door, a full 30 cents turned into pure, unadulterated cash. That is an absolutely elite, high-integrity metric. Very, very few software companies on the planet operate at this level of efficiency. This is the sign of a well-run, mature business that has a deep economic moat around it. But that blast furnace is about to get a whole lot cooler. And listen, this isn't some analyst's opinion or some bearish hot take. This is coming from the company's own forecast. They are telling us, point blank, that their cash flow margin is dropping from that phenomenal 30% all the way down to the low to mid 20% range. That is not a small adjustment. That's a significant drop in efficiency. So the big question is, why?
Well, the company says they need to make high-impact investments to go chase this big AI opportunity. And that sounds great, right? But it's also exactly what every company says when profitability is about to fall off a cliff. Let's be real. A drop of nearly 1/3 in your core profitability margin is a massive change to the structural load of the business. We have all seen companies promise long-term gain in exchange for short-term pain, only to end up delivering, well, just the pain. To me, this feels like a major red flag. They are telling you in plain English they are going to be less profitable next year. Full stop. Look, playing to win costs money. They are making a very conscious, strategic choice here. They believe that by investing heavily right now, particularly in that hypergrowth Base44 platform, they will build a much larger, more profitable structure in the long term. It's the classic textbook case of short-term pain for long-term gain. But you are absolutely right to be skeptical. It introduces a ton of risk. And that brings us perfectly to the other potential issues we found lurking just under the surface.
Exactly. It's time to take out the magnifying glass and look for the fine lines, the hairline fractures, the potential points of failure. Every strong-looking fortress has weak points, and it's our job to find them before they become big problems. Let's start right here. And again, this isn't our opinion. This is a bright red flag from the GF value model over at Guru Focus, a possible value trap warning. Now, what that suggests is that the stock might look cheap on the surface, but it could be cheap for a very good reason, like, say, the declining profitability we just spent 5 minutes talking about. This is like a building inspector flagging a potential structural issue in the foundation. You don't just ignore it, you investigate it immediately.
And here is the first big gaping crack. The headline number that beat all the analyst estimates, the number the company wants you to focus all your attention on, was a non-GAAP net income of $111 million. But if you look at generally accepted accounting principles, we call it GAAP, it's the official rulebook, Wix actually posted a GAAP net loss of $40.2 million. It's like they're telling you they're a world-class athlete who just ran a 4-minute mile, but they conveniently forget to mention they were running on a steep downhill slope with a 30-mile-per-hour tailwind at their back. GAAP is the official level playing field, and on that field, they lost money.
And next, let's talk about this $250 million equity investment from a firm called Durable Capital. Now,
Now, the bulls, they're going to wave this around and call it a massive vote of confidence. And you know what? It is. A smart, sophisticated investor is putting $250 million into this company. But it comes at a cost to all the existing shareholders. You see, the deal includes these things called warrants, which are basically just rights to buy more stock in the future at a preset price. So if the stock goes up, those warrants will be exercised, which creates brand new shares out of thin air and dilutes the ownership of everyone else. It's just like adding more tenants to an apartment building without making the building any bigger. Everyone's slice of the pie just got smaller.
All right, we've put this company through the gauntlet. We have stress-tested the top line, we have checked the very foundation of its cash flow, and we have meticulously inspected it for cracks. Now, it's time to weigh all the evidence and deliver the iron verdict. Let's lay it all out, side by side. The bull case, point one, this is a cash-gushing machine. That $573 million in free cash flow is undeniable proof of a powerful, efficient business model. Point two, they have legitimate new growth pillars with AI and Base44 that could re-accelerate the business. And point three, they've got a major vote of confidence from Durable Capital, and they're using all that cash to aggressively buy back $2 billion of their own stock, which puts a floor under the share price. And now the bear case, counterpoint, that cash-gushing machine is about to be throttled back. And that's by their own admission. Counterpoint two, that beautiful top-line revenue growth is slowing down, right at the exact moment their AI story is supposed to be kicking into high gear. And counterpoint three, they are officially losing money on a GAAP basis, and that so-called vote of confidence from the big investor comes with warrants that could water down your ownership stake in the future. Suddenly, that possible value trap warning starts to make a whole lot of sense when you see all these cracks lined up. So after weighing everything, our verdict is that Wix is a heavy lift. Here's what that means. The company absolutely has a solid base of cash flow and a very compelling growth story with AI. The raw materials are there. They have a proven, profitable core business. However, the path forward from here requires a massive investment, which is actively pressuring their near-term profitability. And the revenue engine is slowing down before these new AI products have even had a chance to prove they can re-accelerate it. Look, this is not a stock for the faint of heart. If you're looking for a safe, predictable, stable investment, this is not it. But if you have a high tolerance for risk and a deep belief in their AI vision, this heavy lift could potentially reach for the sky. Just be prepared for some serious turbulence on the way up.
And at the end of the day, that is the question you have to ask yourself before you put your hard-earned capital to work. Are they methodically laying the foundation for a decade of growth powered by a genuine technological shift? Or are they just a symbol of today's AI-fueled hype, spending a ton of money just to keep up with the narrative? As we've shown you, the numbers present compelling evidence for both arguments. That's our analysis. We've given you the tools to forge your own opinion. This is Iron Financial. Stay strong and always do your own due diligence.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.